We're going to introduce our outlook for the world of energy panel. Are we there yet? Our moderator of that panel, who's going to introduce his panelists, is RT Dukes. I always call him RT. Half the time I can't even remember. RT Dukes with Wood Mackenzie. RT is a leading contributor to Wood Mackenzie's U.S. upstream research efforts. He sits on their internal oil price advisory group that pulls together their long-term outlooks research. He spends much of his time supporting upstream deal flow and strategy work. And prior to joining Wood Mackenzie, RT led a small company that invested in minerals and working interests. And so with that, I'm going to be quiet and let RT come up here and get the show going. Thank you, RT. I appreciate it.
Go ahead and ask the other four guys joining the panel to go ahead and take your seats. I've got the easy job of leaning on the four brilliant guys that Dell and Bill have assembled to join the panel, and so I'll introduce them, from closest to me over. Dell mentioned I work for WoodMac. I'll do a short plug there in terms of what I do. I sit in our research group and advise our clients from an upstream research perspective. So that's my perspective, but we've got a good cross-section here to share how we see everything from the banking to the investment to the management side of the oil and gas and energy world. And so closest to me here is Cody Dick. He is a background investment banker and equity research at Bank of America Merrill Lynch, and now a portfolio manager at Fayez Sarofim. He covers energy and transportation, so he'll share some of his perspective on that side. Next to him is Brett Knowles, who is a VP at EnCap Flatrock. He's a CFA and investment banking background from Barclays as well. He's a board member on several portfolio companies for EnCap Flatrock. Next to him is Jeff Nanna, who works for Tudor Pickering, investment banking background as well. JP Morgan, also operations at Chesapeake, was an aviator and mission commander for the Navy as well. So Naval Academy background. And then to his left is Jeff Voncannon. Jeff, probably known by many of you, but started out as Prairie Production, and then Chevron, was it? Unocal after Prairie Production, and then I think you've been working for your management companies for a little while since then. I think in the 90s you split off and started Redman Management, and he's built and turned around several companies over that time. So with that, thank you guys for joining us today. We've got a good group. I wanted to share a few numbers from last year. So at this time last year, I think oil was, WTI at least, was below 50. I think some of us were praying for 50 at the time. We're over 60 today. Natural gas was about, a little under 3. We're about 270 today, so that hasn't actually changed much. We're maybe down a little bit in that perspective. There were about, let's call it 700 rigs active. Well, let's call it 775 rigs active in the U.S. We're up to almost 1,000 today, so a pretty big increase over that time. So looking up from that perspective, from an activity perspective. LNG exports were just kicking off. We actually are going to grow to about 4 BCF a day this year. Call that 5% of the market, growing to something just under 10 BCF a day over the next couple of years. Oil exports have more than doubled since we met last year, so I think that's something that for a lot of people was a bit of surprise. One, as U.S. volumes began to grow in the second half of last year, a lot of it's finding a home in places outside of the U.S. There's lots of positive stories, strong demand growth, strong U.S. supply growth, which tells us there's a lot of activity here, better oil prices, but we've got some problems as well in terms of margin pressure. What does long-term demand look like? And are we getting enough investment globally to really keep a stable oil environment going forward? And so with that, I'm going to hand it over and ask you guys, and maybe we'll just walk down the line, starting with you, Cody, in terms of, are we really out of the woods? A lot of those numbers sound really positive. Are you looking up from an investment perspective?
Sure. So, I'd start with a couple of things. One is global. So the last 3 years of oil demand have been twice as strong as the prior 3 years of oil demand. So you are seeing the impact of low prices stimulating demand around the world, and that's helping. That's not only helped take some of the inventories out of the system, but that's started to give the U.S. room to grow and contribute to those oil exports and put us on offense. So from a global standpoint, things have improved markedly, particularly starting really the second half of last year. We really saw inventory start to come off in the U.S. and abroad. Domestically, this is how I've been thinking about it. I made the same comment last year. We have a domestic E&P business, which is your upstream producers that are not really making much money, on top of a services business that's not making any money. And so our view was you're going to cost cut as long as you can, and then when you run out of cost cuts, the price has to grind higher. And we've got to get this industry back to where at least is earning its cost of capital. So the oil price move from 40 to 50 to 60 has not been surprising to us in the least. And now really the debate is, can those companies retain profit as the oil price moves up, or is it going to be eaten away by cost inflation? So that's kind of how we're looking at it right now.
Brett, to you, similar question, but maybe from a midstream perspective. One, how are you seeing the macro environment play out, but midstream opportunities as well?
Sure. So on the midstream side, specifically the private side, generally what's a lot of what we do, which is focused kind of close to the wellhead from a midstream perspective, if things are good for upstream and you have production growing and prices, things are good on the midstream side. As Cody kind of mentioned, the last couple of years have been interesting. Specifically 2017, you had, WTI grow throughout the year, ending at $60 at the end of the year, but most of the public midstream and upstream indices on the public side were down, so you kind of had this dislocation. I think when we think about 2018, there's a lot of attractive capital investment opportunities on the private side, but it's still being driven by for us, we make investments hoping to, exit 3 to 5 years down the road. We need buyers that are there ready to buy. And so right now it's not the greatest time to sell, at least what we're seeing, public companies kind of able to finance acquisitions in kind of these challenging markets. And again, all this is happening despite crude being, at a pretty good price. So I think bullish going forward on some things RT mentioned, production growth and a lot of companies continuing to fix their balance sheets on the public upstream and midstream side. So we're bullish there, but still waiting for some things to kind of open up on the public buyer front.
Yeah, so you're seeing supply growth. You would think, well, midstream companies that move those volumes should be doing really well, but from a balance sheet perspective, maybe struggling. I think that's what I'm hearing from you. And then as you move into the E&P space, Jeff, what are you seeing?
Yeah, definitely. I think when you look back over the last couple of years, we've really seen such a huge transformation on the upstream side, and that's where I spend really all of my time. Just in terms of efficiency perspective, you look at what operators are doing now compared to what they were doing 2 or 3 years ago. We're getting more resource out of the ground. We're testing zones that we haven't tested before ever and proving up more resource. And our ability and just overall find and development cost to go get that barrel of oil or that molecule of gas has come down across the board as well. So, $60 in some ways is kind of the new $80 in terms of, dollar per barrel prices, and we've seen that play out in the industry. Cody mentioned return on capital, and that is, that's become a real focus for investors looking at the E&P space. And that's really happened over the last kind of 6 to 8 months, where investors have really started focusing in on really returning capital to shareholders, and that's just been a more important part of the business. I think one of the toughest jobs right now at a public E&P company is perhaps the VP of Investor Relations. Those guys have really been beat up, and they're trying to figure out what they need to do to position their company for success going forward. But we're pretty bullish on 2018 overall. One of the concerns, though, that is out there is definitely on the cost side. You've seen it play out in a lot of the fourth quarter earnings. Companies are forecasting higher costs and inflation creeping in. So it'll be interesting to see how that does play out.
Mr. Voncannon, you play a role on the services side and the operating side. What's your perspective? Are we out of the woods there too?
That is an interesting question that you pose, out of the woods. It's sort of like Bill Clinton's quote, if you do what is, I'll tell you what is, right? But so we're, there's a lot of things that we ask what we're out of the woods at. On the service side, I think we've got some uphill battles that are sitting before us as far as the iron side is at a place that we're going to need to replace some of it. And with things coming politically down the pack, as far as embargoes, that might be tough for us. You're also going to see we're saturated with people and talent trying to get new hands on rigs, and there's some data there we can talk about later. But we're also seeing that from an engineering practices, there's some things that we've learned in the trends that are going to change the way that we look at reserves when we go and buy them. As an engineer, I look at steady state equations that are now being changed that we've used for 15, 20 years that are now different in the shale plays, how to evaluate reserves and how to do that. The fracking stimulation processes are going to have to really change in the fact that they are so intense on data gathering and implementing logistics that's changing a lot of the things you're going to see in 2018 too. So are we out of the woods yet? I don't know. But you know what? When I think of that, are we there yet? Driving a car, I haven't really thought about that till my 4 kids were younger. But I know that RT and all of us on this panel have driven a lot of places, so I'm really encouraged and looking forward to where you take us on our journey today with these questions.
Sure, perfect. Well, I'll keep the next question is going to come to you as well then. Okay. What are the opportunities that you're seeing? I mean, we'll look back and know, we crossed that threshold at some point in the future, and whether we're there yet or not, maybe we don't know, but I think you're seeing, and we talked about it a little bit last week over the phone, what opportunities are showing up today that maybe weren't 2 years ago when oil was $30.
Right. I think where we were the last time we spoke, we were talking about distressed deals still coming to the table, some workouts there looking. Those have sort of gone by the wayside, except for people that are hanging on to them for yield and working through that. One of the data points that I see is that has shifted is, we've drilled 22,000 wells in the Eagle Ford since 2012. And that is a lot of information that has to be done. And we have spent $6.5 million a well probably on average during that time period, which is about $145 billion to gather information. So I think you're going to see deals that are going to focus taking all that information, and maybe you're going to look at seeing a company that maybe focuses on the volatile oil window, for instance, and using data to mine that area. They're going to be very, very focused on those type of deals. Also, I think you're going to see deals, when I mentioned a minute ago, logistics and operations. For management teams going forward, I think you're going to have that incorporated into that part of the equation to look at. I think the gas deals too are very interesting in the fact that now we have a market where we're able to have overseas markets in Asia and Latin America. So we see some things there that are going to be very interesting, where the vertical integration of taking land and going full cycle with it all the way on integration to LNG.
Mr. Nanna, what about you in terms of on the E&P side? I mean, I guess deal flow, how you're seeing that change, what opportunities are you seeing from your perspective?
Yeah, it's 2017 was an interesting year. It started off, very active, at least on the M&A and the A&D side. As you looked at the second half of the year, things really tapered off quite a bit, just in terms of the volume and the flow of activity. A lot of that was driven just by how soft the public markets were, and you didn't have aggressive public companies out there. A few instances you did, but in many cases you didn't because they weren't getting that feedback from their investors. But as we look into 2018, I think. Opportunity-wise, actually, Jeff and I were talking about before we came up here, you're hearing more and more about just technology in the oil and gas space, and it's become big data. There's a lot of buzzwords out there. Our firm is spending more and more time in this area, and we're seeing our clients, the EOGs of the world who've been doing it for a long time, but maybe Devon is more of a new entrant, that are focusing a lot of time, and they're spending a lot of money on technology, big data, data analytics, artificial intelligence, all these things that traditionally have been in many other industries that haven't yet, that technology really hasn't yet gotten to oil and gas. These companies are spending a lot of money on that. So I think it'll be interesting to look out maybe 2 to 3 years from where we are now. If the trend continues, there it could set up as kind of the haves and have-nots as you look at public companies that really invested in it and believed in it, and it actually showed up, in their quarterly earnings, as opposed to companies that didn't really focus on it and didn't pay attention to it and were laggards.
So is that the G&G of today? I mean, we're not doing seismic, we're doing a lot less measurement in some cases on these wells, but we're getting a lot of data points in terms of drilling the wells. Is that the future of G&G? Is it's on the big data? Or are you going to do both? I mean, and maybe go back to you, Jeff.
Yeah, I think it's going to be just a part of what we do going forward, taking that data, able to communicate with it, but deriving deals that are going to be production-driven. There's going to be a lot more required of a team. Where the geophysicists maybe not as quite as important if you're playing the shells. I mean, even though we get 3D data over it, but the optimization in that, our industry is way behind. We're almost last adopters in that what's going on right now.
We're just playing catch up.
Yep.
It should feed through the bottom line. Brett, what about you? You mentioned this a little bit, growing production, looking at investments in that 3 to 5 year time frame. I know we've probably joked and gone back and forth on this before. There were 100 midstream teams looking at the Permian at one point. What are you seeing in terms of opportunity? Is it all Permian? What's outside of the Permian? Is it gathering? Is it processing? Is it longer haul stuff? Where are the opportunities on the midstream side?
Yeah, no, good question. So I kind of teed it up a little bit, I guess, on talking about the public markets and how they've been kind of beaten down the last couple years. So where we're seeing a lot of opportunity, we kind of play in 2 buckets, I guess, greenfield, kind of new opportunity chasing, as well as acquisitions. What we've seen recently with the pullback from kind of strategics, as the M&A market kind of slowed down that Jeff mentioned, is we as a private equity player are being able to take advantage of those opportunities, which is good for us because we've got quite a bit of capital to deploy. On the sell side, that had kind of pulled back a little bit, and you're seeing larger private equity firms come in and kind of fill that void. From a general activity perspective, RT, you mentioned rig counts, coming back up. I think we're about, April 2015-ish levels of rig count. A lot of those rigs are heavily concentrated in the Permian and the Scoop Stack and some of those kind of household names. What we're seeing is still opportunities for a lot of gathering and processing and kind of close to the wellhead type deals, but they are competitive. There is a lot of midstream capital out there. So how you differentiate yourself is important. And things are staying competitive, but from a new, growth perspective, certain parts of the Permian, certain parts of Oklahoma, other basins that have been maybe tossed aside or weren't on the radar for most of the last couple of years are coming back. And I think a lot of that is some of the technology that's, been perfected in the Permian is kind of migrating elsewhere, and that is creating some opportunity on the midstream side as well. Where the rig count and activity goes, so goes midstream. So
some of these deals, maybe up in Wyoming, maybe in Colorado, you're seeing midstream activity follow those. Cody, from an investment perspective, what opportunities are you seeing? And then I have a follow-up question for you.
Sure. Well, domestically, I would say, the history of oil and gas is what starts as unconventional becomes conventional over time. So if you think about that, deep water now is something that is less favorable at the moment, but is something that we got used to doing. Shale is going to be the leading source of U.S. production here very shortly. It'll be more than half of our 10 million barrels a day within a couple of years. So shale will become more conventional with time, even though it's got to require all the technology that's been mentioned up and down the row here. As that happens, we see the opportunity that some of these multiples are going to get reset, where you've had some companies at some pretty big premiums for a while, that they become the more conventional players. And hopefully you get the opportunity to sort out the wheat from the chaff there with some of these companies that are doing a really good job using technology to separate themselves. You also have to think about, if all the capital is going one place, that means there's got to be some opportunities elsewhere too. And, I still think that when you look at the lack of investment globally that's occurred the last 3 years as a result of the oil price downturn, that opens up some opportunities. And we're starting to see some of the fruits of that. Last year, I would say in particular, Exxon and Total, where they kind of got blocked out from buying some E&P companies maybe in that 2015 period. They really went on offense last year and rebooted their production portfolios for really the next 10, 20 years with some of the assets they acquired. I believe, Papua New Guinea LNG, Australia LNG, those are going to be helping China make the conversion and clean up its skies. When you look at what Exxon has accomplished in Guyana, where they've drilled 7 successes out of 8 wells, and probably they've said they've got 3 billion, but they probably have more like 5 billion barrels of reserves that they've found. Those are really significant, highly profitable investments that'll be producing within 3 to 5 years and be a staple in the next decade. So we view the opportunity to pick up some of those businesses with 4% plus yields relative to what we see in treasuries and some rates going up around the world as great opportunities to pick up undervalued assets with some income stream and see those companies make a comeback in terms of operations in the next few years. Just trying to think about where you can use zig when everybody else is zagging to the Permian.
But even Exxon, you mentioned Guyana and Papua New Guinea, but even they're spending a lot of money in the Permian. Where do the integrateds fit, the majors? Where do they fit in this whole game? Because it seems like short cycle. Where can I drill, get a reasonable rate of return, get my money back, especially if we're moving to more value-focused than growth-focused? Where do those guys fit in the grand scheme of things?
Well, I would say if you think about the Permian, the big companies are going full steam ahead now. So you've got Exxon, Chevron, Occidental, and EOG. Collectively probably running close to 100 rigs by the time we're through this year. That's a lot of people and equipment. And then every 2 or 3 of those rigs is going to bring a frac crew along with it. So there's a lot of capital that's going to go there from those companies. For them, where they feel like there's some differentiation, Chevron was one of the few that never sold. And so they have the lowest royalty base in the Permian Basin. They have a huge cost of capital advantage over the industry. And they're going to tie that supply into the chemicals complex that they have with Phillips 66 as their joint venture partner. For Exxon, they see the same things, the benefits of integration. So they can bring the Permian down here to Beaumont, for instance, and connect it to the refining and chemicals. And whether they're exporting the oil or they're exporting a refined product or they're exporting a chemicals product, they see that global growth and demand is outside the United States. And, if you think about the dynamic of where we're at as a country, for maybe the first time in 50 plus years, we're going to be on offense on energy globally, and we'll be supplying that incremental demand. So they see playing all the way through the value chain is where they're at. And I think they want to get where they're growing but not driving the cost inflation. So I think they view themselves as trying to run a steady program that adds a little bit at a time, and with the wherewithal they have, applying some of these technologies that we've heard, where they may have been doing that in other parts of their business and they can bring that to the Permian. It's really interesting, not to belabor this, but when you go visit Chevron and Midland, their team on the Permian is from all over the world. And so they're bringing that expertise from Nigeria, from Asia, from deep water, from different places to the Permian. You go visit a lot of other people in the Permian, people have worked there their whole lives. And so it's a different mentality, not saying one's better than the other, but they're definitely bringing different skill sets. Some may have more knowledge and depth of what they've worked on in the Permian for 30 years. Others may bring different technologies to bear. So it's going to be interesting to see how that plays out.
RT, I too do. I think if we look historically back, I just said we drilled 22,000 wells in the Eagle Ford. And when we got through with that, we realized that about a third of it is good, a third of it's about okay, and a third's bad. And if we follow that model with the rest of the shales, and they've done that, I think we may do a little bit better in the Permian, maybe at 40% that is really good, and the rest is sort of break even or bad. And with what's going to happen there with the service companies that were just mentioned, there's going to be tight things that go on. The unemployment rate in Midland right now, I think we thought we had 10,000 jobs in 2000 and from 12 to 14 that were created. We're at 5 and 6% unemployment. Then we had the downturn. We've recreated that 10,000 jobs, and we're at 2 to 3% unemployment. And it is tight out there. And they've got people from all over the world to source that with things. And I think they're going to win when we go through cycles of crunches that we see through. They're going to come in and have their jobs ready to scoop that stuff up. There'll be exits from midstream companies and private E&Ps, but I think the big winners will be the big boys out there.
So big growth coming out of the U.S. the next few years in terms of oil production. I think we have 2/3, maybe 70% plus is coming from the Permian. You shared a few thoughts, Jeff, and then next, Jeff, maybe what are your thoughts on the Permian? I don't think we can get away from the Permian, so maybe give us some high-level thoughts. And then
Yeah, I don't think it's happening. But as an advisor that sells a lot of assets in the Permian, I'd have to disagree with Jeff on his statistics. The Permian, 90% of the Permian is all core, good stuff. And it will work. That's what we tell our clients and the buyers. But it is an amazing basin for sure, and I think if you put it into baseball innings, I don't know, maybe we're in the 6th or 7th inning. I don't know, maybe not even that far. I think there are still a lot of benches, different zones that have yet to be tested in the Delaware, and we don't really know the full extent of the resource, to be honest with you. So I think we've seen the first round of the big, larger private equity, kind of contiguous blocks transact. We've seen a lot of that happen. We're in a bit of a pause here. And then I think we're going to see another round. There's still a lot of private equity-backed teams that have pretty big positions and big assets in the Permian, and those need to sell pretty soon at some point. And then I think M&A I think is going to happen. It has to happen at some point. It makes a lot of sense. These assets belong in a lower cost of capital structure. When that happens, I'm not exactly sure, and we can maybe talk about it. I think we'll have a discussion on M&A here, but I think the conditions are setting themselves up that we could see a lot of that activity.
Well, and maybe, so that activity is coming. What are the challenges? What keeps you from getting there to that next stage of M&A, and then maybe just more in general in the market? What are you seeing as the biggest challenges? Yeah,
if you look at the Permian, there's 17 Permian pure play E&P companies. Majority of those are small cap companies. That's a lot of G&A. It's a lot of overhead for the Permian. You don't need that many public companies. And I think investors kind of think that way as well, and they'd love to see consolidation, at least the folks that we talk to. And I think they could make a lot of sense. It has been difficult to pull off kind of big corporate M&A, stock-to-stock transactions. Part of it has just been so much volatility in the market. It's been very difficult to get those exchange ratios to align for more than a week or two. And it's just very difficult to pull off M&A when you can't have both sides agreeing with each other on what each of them are worth, to be honest with you. And so that has been pretty challenging. So I think we need a market that kind of steadies out a bit. That will help support M&A. And a lot of these companies, they're trading off their 52-week high. The Permian guys are probably trading the highest, but they're trading at about 80% of their 52-week high if you look at the median of the group. And so if you're going to come in and acquire that company, they typically want to get something above their 52-week high. And so then you're talking about, you're probably stepping out from a low premium type of transaction into something that's maybe a 20, 30, 35% type premium in this market. Investors aren't probably getting as excited about that if the investors of the company that's acquiring. So, again, I think we need to. I think ultimately, though, I think what could drive that is those higher kind of low premium offers in transactions. I think what could drive that and the success of that is going to depend on the synergies that are involved. And in many cases, it's making a lot of sense for these companies to combine. Part of that is that the basin as a whole is going to longer laterals. And there are a lot of dyssynergies on the land side with companies that are interlocked with each other, that if you just join the two companies up, it would make a ton of sense operationally and just in the way you drill the wells. So I think it's coming.
Brett, from a midstream perspective, same people. I know you're looking for management teams from is maybe the bulk of your job, but are you seeing the same tightness in the labor market? I mean, are your portfolio companies struggling? What are the challenges you're seeing on the midstream side?
Yeah, so on the challenges there, haven't seen it as much on the labor market side. When we form these private companies, most of our management teams have folks pegged and are able to, build out their team pretty well. And so that hasn't been much of an impact. In terms of other, challenges I kind of mentioned, it's really been, a lot of private capital has been raised. And we've been fortunate to be, a piece of that raising. But now it's, how do you get creative? How do you, whether it's joint ventures or other types of structures that are out there, the Permian continues to be a place where we've invested a lot of capital. And, given the upstream economics and the activity levels, we'll continue to focus out there. But again, it's how you can, how do you set a competitive advantage, whether it's the management team's track record, what they've done in the past, and how we can really support them there. Meanwhile, as I mentioned, acquisitions and other types of opportunities, because the public strategics maybe aren't growing in that way, is something we're kind of watching. And then I think you are continuing to see other, you're trying to get in the core of, the Delaware, the core of the Midland right now. That's going to be pretty difficult as a new midstream entrant. But you are seeing activity press outside what was considered core. And of course, 2 years ago, what's core now was fringy. So there is still that growing. You have some, aspects of the Central Basin platform that folks are trying to crack. So continuing to see different new opportunities. And we're just trying to stay in front of kind of all aspects of those.
Cody, Mr. Nanna talked about, and I should have thought about two Jeffs on the panel and how I was going to distinguish between the two. I keep going to say,
You can call me Red.
Jeff said, and there's two of them up here. So second Jeff, closest Jeff to me, mentioned the equity volatility.
Sure.
The broader market up over 30% last year. Equities had a little bump at the end of the year, but we're still only up 20%. They've come off those highs, and it looks even worse. I mean, it's pretty ugly in energy equities. What changes this volatility that we see in the equity markets for the energy guys?
Well, I think one aspect is nobody believes it till they see it. So if you look at the history of the futures curve, which today the futures imply more like $50 in 2020 than the 60 we see in the spot, it takes about 9 months for people to believe that the oil price is going to stick. And so we're month 5 or 6 there right now. So there's still a lot of angst and hand-wringing over where do we go from here? Has demand been too hot to start the year? There were 3 months ago or 4 months ago, we were talking about how electric vehicles were going to end the oil era. I think there's a little bit less of that notion now that we see how hard they are to make and deliver, and that they still run on a lot of things that aren't renewables. The next panel can talk about that. But in general, I think if as an energy-focused person, our firm is only about 10 or 15% energy, but looking at the energy industry, the 10% or so freak out that the market had here in February, we're seeing that every 2 or 3 weeks in energy, and we have been for 3 years. So I think we're a little bit more accustomed to it, and it really gives you a chance to find some opportunities with time. A lot of the stocks hung out at premiums. They didn't trade off with the oil price, at least some of the great things that we like to look at. And so now that they are, it gives us a chance to look at some new ideas. And we're starting to figure out, who are going to be the winners of the shale era, who's going to be able to consolidate. Do they need to consolidate? And things are changing as well. If you look at the major oil companies in 2017 versus 2013, their cash flow was down about $60 billion, which sounds pretty terrible, but their CapEx was down $100 billion. So free cash flow was actually better in 2017 than it was in 2013 for that group. And if the oil price hangs around another year, that can really start to change where we're at as an industry. The majors are either going to creep back and start increasing some dividends again, buy back some stock, take down some debt, or they're going to start looking at some of these assets that they're talking about. So I think, we've got a few more months in terms of the out-of-woods discussion, but things are on the cusp of some changes.
What about the U.S. independents, though, just to be more specific? They kind of got a pass on outspending cash flow. The capital markets were really stepping up. I mean, there are knock-on effects when your equity's not performing very well. Your debt metrics look worse. It's harder to finance projects. Are those guys, are they just in the next phase? They're going to be held accountable? Held to those same standards of free cash flow and maybe giving some money back to shareholders? That's what some of them are doing in the first quarter.
Well, Conoco kind of set the pace for that last year in terms of trying to reboot their business. They had to face a dividend cut that they took after splitting off Phillips 66. They had maintained a pretty high level of a dividend, and they went ahead and took the cut. They sold their oil sands assets. They paid down debt. They're improving their cash margins and return. And now they're in a position where their balance sheet's been reset. They're taking the dividend back up, and they're able to buy back a little bit of stock while the shares are still reasonably priced. And they were the most successful company out of the large cap E&Ps last year in terms of stock price performance. So now you've got the imitators that are coming, and we've seen that from companies like Anadarko, Marathon, and others so far. Mm-hmm. And I think eventually you're going to get there. The big Permian names, there's some changes at the top. So if you look at Pioneer and Parsley, you've got family changes there underway at both companies. Pioneer last year put out 10-year guidance. It's kind of hard to think about that for E&P companies, given what we've seen the last 10 years. But their view is we want to be steady. We want to get out of us being so cyclical. And when the cash flow is available to return, we're going to return it. And we'll preserve our balance sheet for when there's a part of a down cycle. And I think you've got some of the E&P companies that were smaller, that went and built businesses, that now they've pretty much acquired what they wanted to acquire and are looking for either the next phase of their own personal life or the next phase of their company's life. And now it's about development. Sometimes development is a lot harder than actually acquiring the assets. So that's where things will start to change hands. And you're seeing some of these things happen in the C-suite in the Permian Basin.
Closest, Jeff, Mr. Nanna. Do you believe it? I'm skeptical to some degree. I've kind of looked at it, and companies have been talking about, we're going to be more value focused. We're going to give money back to shareholders. And I go, well, maybe at 55 they'll do that, but at 65 we'll see. And we kind of got there, and they have. And then I see things like last week where one of the only positive stories was a company called QEP, basically saying they're going to become a Permian pure play, $2.3 billion market cap, and they're going to buy back $1.25 billion in shares. And I went, well, if you wanted to surprise people with your story, you did that, and the market reaction was positive. So I guess from your perspective, do you think this is here to stay? Is the management account more long-term accountability for management instead of short-term growth targets? Are we really going to see the focus shift?
I think it is. I think companies need to be disciplined, but also investors need to be disciplined too and not reward that kind of crazy growth and outspend just because commodities maybe bump up and support it for a while. I think it's kind of a partnership in that regard. So I think, right now investors are kind of on a wait and see and prove it to me that you guys can do this, and not just this quarter, next quarter. I want to see maybe a full year of you doing this, regardless of what's happening maybe in the broader market, and show me that you're consistently devoted to this concept, and then I'm going to reward you. And so that's kind of the generalist investors, the big funds out there, I think, are looking for that.
So prove it to me. We're in that stage. Mr. Voncannon, next, we talked about, and you alluded to this, big data and how data analytics and how important it is, even in the management teams that you talk to. Can you give us some specific examples? Where it's making a difference and what you think it'll change?
Yeah, one of the things that has occurred, we talked about the Permian being hot, but if you go up northeast from there and you go to East Texas, you're seeing the Haynesville become revitalized, and you're seeing companies that have taken the big data and they're using it and they're applying that new technology and making some monster wells, and they're from big to small. Even from you have Rock Cliff who's a smaller type of company that's made a move doing that. You've got Chesapeake, Indigo, Covey Park. And then you look down south, and BP has made a huge day with data. They even say that they have been looking at taking their production and optimizing and doing runtime, and they're one of the big guys that has made a move. There's also what we talked about before. There's going to be winners and losers in East Texas because of that data. I think we're actually going through some type of shift in the way that our industry does things, the way we view it from private equity to the way the majors and everything does. And I believe that you're going to see a roll-up of companies there. Not everybody can move that much gas that quick out and efficiently. So the data will cause them to merge. I don't know who's going to be there at the end of the day, but a lot of the PE-backed companies were looking to get in there and then go take an IPO. Gas came back, it's delayed it, and roll it up. So I guess to answer your question, RT, you see BP doing it, you see these independents doing it, you see in the data that has been done from the Eagle Ford and from even the Delaware, and it's moving so fast that it's just, I mean, I'm over the age of 55, right? So anybody that's older than me, my big brothers that were like 60, in their 60s, it's hard for them to even get their arms around it. I'm trying to be a bridger. Right. So I don't need to work on Excel. I mean, working on something that gets that digital stuff popped up. So it is, it's amazing.
Well, and it's maybe a natural phase of development in terms of they were all drilling companies for several years, and now they're becoming, as the volumes become material, they're production companies again.
Right.
There wasn't much P there for a while in E&P. With that, I've got a lot of other great questions, but I want to open it up. I know Dell's going to have a question. Bill will probably have a question. Who else? Anybody have any questions you want to pose to the panel? Go ahead, right here while I'm waiting for the.
Just from it generally, what are your thoughts on the development of the Mexican imports, refined products, and all of that? How do you guys see that going with the upcoming election and other factors?
So I'll repeat the question. Volumes going to Mexico, basically, is that broadly the question? How do you view those with the election risk and so forth? Brett, do you see any opportunities there? Are you looking at?
Yeah, no, good question. So the election risk is one of the reasons why I think over the last few years we've had some, on the midstream side, some of our companies kind of kick the tires down in Mexico. To date, we've been reluctant to actually own any assets down there. I think you still have a massive, short, of gas and diesel into Mexico, and seeing that continue, I think some of the opportunities are, you look at a Corpus Christi, what's happening down there from a lot of the new crude pipes kind of leaving the Delaware that we didn't get to really talk about, but a lot of crude oil and other products, NGLs, going to Corpus, getting staged there, and either getting railed down into Mexico or barged. We have companies pursuing those types of opportunities. The election risk, just given that rhetoric and seeing how things can quickly change down there from a holding an asset perspective, we're probably less excited about. But the I guess just fundamental issues that Mexico is dealing with, as well as on the heels of BP putting 150 plus retail stations down there, Tesoro Endeavor, bigger folks wanting more of a presence. I think that makes us more excited. But again, it's so I think they'll continue to deal with those headwinds, which is not a lot of money put into refineries with growing product demand. But in terms of how to actually invest in Mexico, that's going to continue to be probably a piece of diligence that we're going to have to think about.
Especially with elections and everything. This is a follow-up question for you, Brett, real quick. What type of liquids are we seeing out of the Permian, Eagle Ford, even the Delaware Basin? How much of that will need to be exported versus are we going to have to expand refining capacity here? And then who benefits most? So two-part question, Corpus or Houston, with whether that's exported or refined here.
Yeah, no, good question. So a lot of the NGLs coming out of, you've got really over the last few months, companies like ONEOK announcing big NGL expansions, whether that's out of the mid-continent, getting it down to Mont Belvieu, down here in the coast, or that's out in the Permian with Targa and others. I think a lot of those NGLs or natural gas liquids, propanes, butanes, ethane, that's going to have to get exported. A lot of it will. You do have new fractionators getting built down in Mont Belvieu. And that's probably going to benefit chemicals and other folks down here. Corpus is interesting because I think it's going to continue to make waves. It's viewed as having a ship dock a ship channel and barge traffic, ship traffic that's maybe a little easier to navigate than Houston. But of course, it doesn't have kind of the ready infrastructure there. But it's got large Exxon's big chemical facility. It's got fractionators getting announced. A lot of infrastructure projects down there, and it's going to take a lot of the product. But I think Houston will continue to get a lot of that as well.
And I want to get through, we've got about a minute, I want to get through these last couple of questions. Cody, you had some comments on this. The question's about supply risk outside the U.S. Is it a spigot you can turn on and off, or are we worried about declines? But you also had some comments on macro risk in general, if you want to share those.
Yeah, in terms of supply risks, I mean, the big things people are looking at right now are Iran and Venezuela. And Venezuela, we've thought we've spent the last 15 years thinking it was going to collapse the next year. So it seems to be able to somewhat keep the lights on longer than we think. But the oil volumes have really come off there the last couple of months. They're in a bad spot. And so where they had been producing 2 to 3 million barrels a day, it's certainly not more than 1.5 million now and falling. And things will come to a head there. They just pushed the election back from April to May today, and that's going to defer sanctions that the U.S. was likely to put on Venezuela. Iran is another sanctions target. It's pretty certain that Trump will move in that direction, given his disdain for the Iranian deal. The question there is, do the Europeans cooperate with that or not? And the last time we put on sanctions, it took 1 million barrels a day off the market. I think that's a little less likely this time if the Europeans don't go along with it. But that is a risk. And then Libya, yesterday a landowner went out and turned a valve off on a pipeline on his land and cut off 300,000 barrels a day. It's basically Libya. The situation is they have money, they have oil production, and then when they don't have money, somebody goes and turns a valve or fires a missile. So Libya is still very volatile. That's really the third hot spot right now. And those are the things that I think are needle moving short term. The long term question that everybody in this room ought to have is this. The Saudis have put on what they call oil cuts to take down inventories. The big question is, are those oil cuts or are those declines? And when we need to ramp up the volumes, can they do it? And is it going to take 100 new rigs to actually do that, or can they ramp it up in 6 months or a year? I think it's going to be pretty hard to ramp up volumes, and that's going to be the big question whenever the OPEC cuts go away. Do the volumes actually come back, or has Saudi been masking declines all this time?
Maybe if the oil price is higher, it's a little bit easier. Mr. Voncannon, on the end, this is a data follow-up, and actually the last two questions is probably for both of you guys on the end there, but you mentioned the data on 22,000 wells in the Eagle Ford. When you say that, do you mean the public data that's available that people can work with, or do you mean that the proprietary data that the operators are gathering that might give them a different strategic advantage? Can you work with the public data, or?
Yes and no. You can work with some of the public data, but there's a lot of information. When we spend $100 million in a year drilling wells, we're going to keep that data pretty close. I mean, that's sort of our advantage. So you can share it, you can buy it, you can trade it. So it's a tight network. You may even have portfolios or PE firms that can understand that and do that. So does that answer your question?
I guess the one thing I would add there is, when you think about data as a concept, data is something you have to create. It just doesn't exist. And a company like EOG creates 100x the amount of data that a small private or even a small cap public company that is not really kind of into that space produces. And that's where it becomes a competitive advantage. So I think it used to be that the public data was sufficient, I think. Right now, I think it's becoming less and less a competitive advantage just to be able to analyze that public data.
And also, I can add to that.
Yeah, go
I mean, you're going to see in the future small companies that are backed by PE firms that will have a niche, and they're going to have, I mean, they may be running submersible pumps on all the wells that in these trends that go from 20 to 10, and they're going to have data feeding them every minute or every 30 seconds or however long you want to, and they're going to have guys analyzing it, pushing it back, and optimizing it, and they're going to make a lot of money. And it's going to be boring, labor intensive, but it's going to be very interesting.
You know, that sounds like a service heavy job, and this last question is there, and we'll end here. But, you know, the question is, oil's gone from 50 to 60, but some of these service company stocks haven't really recovered. Weatherford, maybe a bad balance sheet, and others. What's keeping some of these service companies from really bouncing back? Anybody want to volunteer to chime in, or?
Well, you know, the services business, you've got a lot of different companies in that space. I think, you know, they're all a little different. Schlumberger is more global, trying to move back into the U.S. a little bit. Halliburton is your 800-pound gorilla in North America. And their business, the questions are, is pressure pumping becoming more commoditized, or do they get paid for logistics? The question is, how do they get paid an outsized profit relative to the peer group, where you can go start a new sand mine, you can build some frac equipment. How do they differentiate themselves? You know, Weatherford has had to kind of peel back the onion, a lot of layers. I don't know how many are left, but they've had to really address their issues and their balance sheet, and they're trying, and we'll see if they get through. Baker Hughes and GE, I have a lot of opinions about how Baker Hughes ended up with GE, but the bottom line was that you had a lot of number threes and number fours relative to the history of GE, saying that they had number ones and number twos. And you combine threes and fours in a down market, it just doesn't work all that well. And then National Oil Well is a fantastic business. It's as close as there is to a monopoly on equipment and in oil services. But they make so much money building deep water rigs relative to everything else that you really need deep water to come back at some point to give them that boost. So those are the big companies that I follow, and they're all just a little bit different.
Well, we didn't talk about EVs and a couple of other topics that I think the next panel, we're eating into their time, so I think it's a good segue into the next group. Join me in thanking these guys for enlightening us here.